Okay, let's go. We're going to look at Chapter 14, some of the key points. Remember that when you're issuing bonds, they can be issued at par, at a discount, or a premium, and it really just depends on the market conditions. We know that premiums and discounts are amortized over the life of the bond. There are two ways of doing it. One is straight line, and the other is to use the effective interest rate. The straight line method is really simple. Effective interest rate, a little bit more complicated. Point is that all the changes are tracked using an amortization schedule. It's going to look something like this. Exactly what it looks like doesn't matter. The point is that accountants need to keep track of these things for consistency so they have something that they can look at and look back on and see if their calculations were correct. So we're going to look at some problems, and this is pretty straightforward. We've got Plum Inc. They have a liability associated with an $800,000 4% 5-year bond. We're told the date it was issued and that it yields 4.5%. So the question then is, what's the liability at the year end, December 31st, 2015? So we need to fill in the information to do a present value of the cash flows. And so the rate we're going to use is the 4.5%. The payment, though, is the $800,000 times 4%. This is the amount that the bondholders are actually going to receive each interest period. And the future value is the face value of the bond, $800,000. So when you use your present value calculator or Excel or whatever method you're going to use, you're going to find the present value is $782,440. That's how much the bonds were issued for, not the liability at the year end. So that's at September 1st. In order to answer the question, we have to go a little bit further. Here's the bond table. This is what it would look like. You don't have to do all of this, but just to give you a sense of how it's done in the real world, here's where we started from on September the 1st. There is no December 31st on the table. So the table's yours to do what you want with. So let's go a little bit further, and we're going to set up a column to amortize to December 31st because we always need to know what it is at the year end. This amount, the 1,070, is simply the amortization of 3,210 for September, October, November, and December, or 4/12. And that's going to equal the $1,070. That tells us the balance at the year end. We can then easily create the journal entry for the year end because we have to reflect this, of course, on the financial statement. You can see the amortization of the discount showing here. And the interest expense, again, is the 35,210 times 4/12. I like this column here. I like to use it just so I can keep track of exactly what I'm doing, and it's great if you guys do it as well because it helps me to see what you're doing. Let's look at a different question based on the same information, only here the bonds were issued on January the 1st. Interest is payable annually, and the bonds are going to be redeemed at the end of 2016. Some bonds are redeemable at different points in time. The mechanics behind it, though, are always the same. Let's take a look at the transaction. Since the carrying value of the bonds at that date are $789,004, which, by the way, the question told us. We know that they're going to pay $808,000 to the bondholders, and we just calculate the difference and we call it a loss on redemption, or a gain on redemption if that's what happens. Same question, nothing's changed here, but we just changed the date, so now it's being redeemed on March the 1st. So it's just a little bit more complicated because we have to figure out how much interest expense we have, how much interest is payable to the bondholders, and then we have to calculate the gain or loss on redemption. So same kind of situation. We're looking at December 31st, we have $789,000. We want to calculate the amount of interest, and we just use the amounts after that date. And since it's 2 months, we're going to use 2/12 of that to calculate the interest expense, the interest payable, and the bond payable. And keeping in mind that in order to redeem these bonds, the company will have to pay the $808,000 plus the $5,333 in interest payable. As a result, the journal entry will be to clear the bonds payable, to clear the interest payable, to record the cash that they have to pay out, and then we'll have a loss on redemption. Sometimes instead of redeeming bonds, they'll be exchanged for something else. And just reminding you that while this particular presentation is all about bonds, bonds and debt are treated very much, almost identically for accounting purposes. And so whatever you're learning here, you can apply to loans as well. It's the same concepts. So exchange of debt instruments, same question, only now the bonds are exchanged for different bonds with a different interest rate, and they're due 5 years out. So they're not being redeemed now, they're being exchanged. So we're going to look to see how we handle this. And this is just a little bit more complicated because we have to look to see if there's a substantial modification. There's two conditions that we would say there is a substantial modification. The first is that there's at least a 10% difference between the old debt and the new debt, and we measure that by using the discounted present value of the old debt. And we also use the discounted original effective interest rate. The second condition, change in creditor original debt, we're not going to talk about. It's pretty obvious that does mean there's a substantial modification, and you just go ahead and treat it that way. So here we look at a case where we're trying to determine whether there's a 10% difference or not, and I ask you to guess. You know, it's kind of fun, but we're going to actually look at whether or not there's a substantial modification. So we use the old rate of interest, the old effective rate of the new cash flows. And that's the 4.5%. The new cash flow is 5 years. The new interest payment is $40,000. The future value is the $800,000 still, and the present value is $817,560. When we compared the two, this was the present value of the old debt. We already had that calculated. We didn't have to redo it. We just calculated that. Take the difference. You're looking at the change from the old to the new, and you can see there's a 3.62% difference. So there is no substantial modification. We treat it then just as a normal modification, and there's no gain or loss. What that means is that at that point in time, the liability on the financial statement will stay at $789,000. Nothing happens. But going forward, we need to find a new discount rate to use. Here I've used rate to calculate it. You can use your calculators. And we see that the new effective interest rate is 5.3203. The amortization schedule then changes to use the new effective interest rate, and I've just created the schedule so you can see that that does work. We're using this as the present value at December 31st, running it through. Same problem. Now we're exchanging them for bonds, same amount of bonds, but 7%. Everything else is the same. We're going to look and see if there's a 10% difference. If there is, then we're going to treat it as a settlement. That means we will record gains or losses. If not, we treat it as a modification, as we just saw. So is there? We now do the same kind of calculation. We do the present value, but we use the new interest payments because there's 7%. And we see that the new present value using the old effective interest rate, is $887,800. Do a side-by-side comparison of these two numbers. And we can see there's a 12.52% difference. And so, yeah, now we've got a substantial modification, and we'll treat it as a settlement. And we'll record a gain or loss on settlement. What is the gain or loss? Well, the fair value of those bonds is $800,000. They were issued at par. The carrying value of the old bonds was $789,000. So the gain or loss is the difference between the two. Call it loss on restructuring, and it's $10,996. Same problem. Now we're looking at the bond being exchanged for common shares. We know the market value of the common shares. We also know that the market rate for this bond is 7%. So we're going to treat this as a settlement. We are going to record, in this case, a gain on the restructuring. It's pretty simple. Really, it's a matter of looking at the problem, thinking about it. Think about what's actually going on, then looking at the solution, and then you usually can create the journal entries fairly accurately. That's a really quick recap of what we went over in class. I hope it's helpful, and I hope that helps you with the test as well. Looking forward to seeing you next week.